Welcome to IAS Project. We are continuing with the videos on Indian economy for UPSC Civil Services Exam. Now let's look at market prices. So we have already seen what is factor cost. Factor cost is the cost that goes into production. For example, if you want to produce something, you will incur a cost which is called as factor cost. Factor cost is a cost or amount that is paid to the factors of production. We added something called production taxes minus production subsidies. So we called this as net production taxes and we got what is called as a basic price. Now, if you are going to add product taxes minus product subsidies, we get what is called as a market price. This is actually the price at which the goods and services are available in the markets. So let's look into market prices. Market prices are also called as buyer's prices. We know that basic prices are called as producer's prices. So basic prices are producer's prices and market prices are buyer's prices, because these are the prices at which buyers buy the goods and services. Market prices are the prices at which goods and services are available for buyers in the market. When we add product taxes less product subsidies to the basic prices, we get market prices, as we have seen here. So let's look at the formula. Market prices include basic price plus product taxes minus product subsidies. We know that basic prices are nothing but factor cost plus production taxes minus production subsidies. So the big formula for market prices will be compensation to employees plus operating surplus or mixed income plus consumption of fixed capital. These three form part of factor cost. And to the factor cost, we add production taxes and production subsidies. Till here, it becomes basic price. And if we add product taxes and remove product subsidies, we get market prices. Let's look at what are product taxes and product subsidies. Product taxes are charged on per unit product basis. For example, if you have started an enterprise, let's say the enterprise you have started is manufacturing water bottles. We have seen that irrespective of the number of water bottles you produce, production taxes are not going to change. However, depending on the quantity of bottles you are producing, product taxes are charged. So product taxes are charged on per unit of product produced basis. Example of product taxes include excise duty, which is charged on manufacturing, GST, which is nothing but goods and services tax. This is the chief indirect tax at the moment. Also, import and export duties, which are charged on imports and exports. These are also charged on quantity basis. If the quantity is more, import duty and export duty is more. Product taxes depend on the volume of production, that is the number of bottles you are producing. Product taxes are also called as indirect taxes. Let's look at product subsidies. These are the subsidies that are again given on the per unit of product basis. So they depend on the quantity of the product which is being produced. Example of product subsidies include food subsidy, fertilizer subsidy, interest subsidies to farmers and households. For example, food subsidy in FPS shop you may see, fertilizer subsidy you may see the number of bags of urea the farmer is producing, the greater is the subsidy that is provided to him. Now let's look at what are transfer payments. Transfer payments are unidirectional payments basically, and they are not paid for return of goods or services. So what this means is that there are two entities A and B. A is giving a payment or transferring a payment to B, but B is not paying back any goods or services in return. Such kind of payments are called as transfer payments. Examples of transfer payments include pensions, student stipends, UBI, etc. Pensions may come from, let's say, government. Student stipend may come from, let's say, universities. UBI also from government. So transfer payments are not only from government but also from any other entities. Transfer payments are often used for governments for the income redistribution for selected sections of people. We know government imposes income tax on salaries. Income tax generally increases with the amount of salary you are getting. So there are different slabs within the income tax, and if you earn below a certain slab, there is no income tax for you. But you are earning so much, let's say you are earning, let's say 50 lakhs. The tax is so high. If you are earning to 20 lakhs, the tax is relatively less compared to what is the tax on 50 lakhs. So what happens is, as the income increases, the amount of tax also increases. So that higher income people contribute more towards income tax and lower income people contribute relatively less towards income tax. So the amount of money which is collected by government from high income people is actually used in a way on low income people or people who do not pay any kind of tax in the form of transfer payments. They may give them let's say old age pensions. They may give them free health care and all these aspects. Such kind of taxation where income tax or any kind of tax increases with increase in income is called as a progressive tax, because as you earn more, you are taxed more. And such kind of increased tax is used for benefiting the people who are on the lower ranges of the income. So it is called as a progressive tax. So transfer payments are mostly used in the form of income distribution for selected sections of people, which usually means poor people or people who are at the risk within the economy. Transfer payments are part of personal income of the individual. So this is the main difference between transfer payments and subsidies. Subsidies are often linked to goods and services. We have seen that food subsidy is linked to food, fertilizer subsidy is limited to fertilizer, electricity subsidy, water subsidy, and all the subsidies are linked to particular goods or even services also. But transfer payments are not linked to any goods and services. You will get pension because no goods or services are expected from you in return. Similarly, student stipend, universal basic income are also example of transfer payments because they are not linked to any particular goods and services. Recent example of transfer payment includes PM Kisan transfer funds for farmers by Government of India. We know that under PM Kisan or Kisan Samman Nidhi scheme, government is paying 6k rupees or 6,000 rupees per annum to farmers in 3 installments. This is unconditional payment to farmers. So this amount, that is 6,000 rupees, which is given to the farmers, is not linked to any goods or services like food, fertilizers, electricity or water or anything else. So this is called as a transfer payment and not a subsidy. So let's look at factor cost, basic income and market price once again. First we will see factor cost. Factor cost is nothing but compensation to employees, consumption on fixed capital and operating surplus or mixed income. We call this operating surplus in case of incorporated enterprises. We call it mixed income in case of unincorporated enterprises. So if we include factor cost with production taxes and remove production subsidies, we get basic price. If we add to basic price the product taxes and remove product subsidies, we get market price. So this is the relationship between factor cost, basic price and market price. Now let me ask you a question. Is market price always greater than basic price and basic price greater than factor cost? Is this true or not? The answer to this question lies in the value of production taxes and production subsidies and product taxes and product subsidies. Whichever is greater will impact whether this sum is positive or negative. So please comment in the answer section, is it true or not? If it is not true, please tell me an example of such kind of product. Let's look at some practice questions. In reference to the following assets, we have 5 different assets given here. Which of the following assets is a depreciating asset? So the first one is taxi. Is taxi a depreciating asset? Yes, we have seen this. Taxis depreciate at 45% a year. The second statement is, second option is taxi driver. Human beings are not depreciating assets. What about land? Land is also not a depreciating asset if we only consider land. However, if we consider land in terms of, let's say you have agriculture land and there are mango trees. Mango trees can be depreciating assets because their life is limited. But land itself is not a depreciating asset. Commercial building, yes, usually 1% per annum is the depreciation rate for commercial buildings. Intellectual property, yes, intellectual property is also considered as a depreciating asset. So the answer is, which of the following assets are depreciating assets? 1, 4 and 5. Answer C. Let's look at the second question. Factor cost includes production taxes but not product taxes. Answer is, this option is wrong, because factor cost formula is nothing but compensation to employees plus consumption of fixed capital plus operating surplus or mixed income. It does not have any kind of taxes in it. Market price includes both production taxes and product taxes. Yes, this is correct. Basic prices include product taxes but not production taxes. This is wrong, because basic price does not include product tax, but it includes production tax. So the answer is B. Let's follow up in the next video. Please like and share this video. Also subscribe to IAS Project. Thank you.